BETR is down 42% in the past month. The mainstream red is struggling lender, weak guidance, avoid. I own 1,700 shares and I haven't sold a single one. Here's exactly what I'm doing with my money and why I think the market has this completely wrong. By the end of this video, you're going to understand three things. One, why the stock dropped 42% and why the cause matters more than the number itself. Two, the business hiding inside this so-called mortgage company that most retail investors have no idea even exists. And three, the one reason I'm not running my usual options strategy here, and what that says about my conviction level. But first, we need to talk about something that happened on the other side of the world, something that has absolutely nothing to do with mortgages. And when you understand that connection, everything else falls into place. In late April 2026, the conflict in the Middle East spiked oil prices. Higher oil pushed inflation expectations up, and when inflation goes up, mortgage rates follow. The CEO said it directly on the earnings call. Rates on their platform went from 5.75% to well over 6.5% in just a few weeks. Think about what that means for a homebuyer or someone refinancing. At 5.75%, maybe they can make the payment work. At 6.5%, they can't, so they freeze. They stop. They wait for something to change. That is the entire reason BETR's Q2 guidance came in below expectations. Not a broken product, not a failed business model, not a management problem. One external event, one temporary cause. And here's the data that proves the business is actually getting stronger, not weaker. Revenue in Q1 2026, $47.5 million, up 52% year over year. Funded loan volume, $1.64 billion, up 89% year over year. They beat the high end of their own guidance range on loan volume. And here's the number the CFO led with on the call. Revenue grew 52%. Expenses only grew 27%. That gap is called operating leverage. That is what a business looks like when it's getting more efficient every quarter, not less. The adjusted EBITDA loss shrank 48% year over year, from minus $36 million down to minus $18.8 million. Let the numbers do the talking. This was BETR's strongest quarter ever on every metric that actually matters. The guidance miss had one cause, a war on the other side of the world that temporarily spiked mortgage rates. Now let me show you what this business actually is, because here's where most people's understanding completely breaks down. Most people think BETR is a lending company that happens to use a little AI. That is the wrong frame, and it is exactly why this stock is mispriced right now. Here's what they actually built. BETR needed to process mortgages faster and cheaper than every other lender, so they built their own AI platform. They called it Tinman. Tinman cuts loan processing time to 24 hours. It reduces per loan cost by 30 to 50%. It handles underwriting, customer service, and processing. And here's the key part, it gets better the more loans it processes. Every loan makes the model smarter. That's a data flywheel that legacy banks can't replicate without a 5-year rebuild. Then they had a realization. Think about what Amazon did with AWS. Amazon built world-class logistics infrastructure to run their own store. Then they realized they could sell access to that infrastructure to everyone else. AWS is now Amazon's single most profitable business segment. BETR did the same thing with Tinman. They built world-class AI mortgage infrastructure for their own lending. Now they're selling access to banks, brokers, and fintechs that don't want to build their own. In 2024, Tinman processed 0% of BETR's funded loan volume. In 2025, 36%. In Q1 2026, 50%. $821 million of the $1.64 billion they funded. 0 to 50% in 18 months. Credit Karma 140 million members runs on Tinman. Finance of America, NEO Home Loans. A top 5 non-bank originator, the CEO tells every bank partner the same thing. We're going to help you double revenue and cut your cost structure by 30 to 50%. This is not a lending company with AI bolted on. This is a software company that also does lending. The market is pricing it like the lending company. The analysts who just initiated coverage are pricing it like the software company. And there's an enormous gap between those two valuations. Here's the single piece of data that convinced me this problem is temporary, not structural. In April 2026, the same month the stock was crashing, something interesting happened on the demand side. BETR's biggest Tinman partner saw pre-approval volume double from $100 million a day to $200 million a day. Read that again. Consumer demand doubled while the stock was selling off. While conversion collapsed, people aren't leaving the housing market, they're getting pre-approved and then refusing to lock at 6.5%. They're on hold. They're waiting for rates to come back down. The CEO called it a limit order, like in stock trading. You come in pre-approved. You set your target rate. When rates hit that level, the system pings you automatically. That demand doesn't disappear. It queues. He said on the earnings call, this is a coiled spring. When things die down in the Middle East, you're going to see some bumper months. $200 million a day in pent-up pre-approvals, waiting, all needing one thing to unlock. But before I tell you exactly why I'm holding, I need to be completely honest with you about the risk, because the bear case here is real and I won't pretend otherwise. If you're looking at better, you need to see the actual bear case, not the watered down version. At the end of Q1, Better had $64.3 million in cash. They raised $69 million more in a post-quarter stock offering, diluting existing shareholders just to stay liquid. Total liquidity roughly $133 million. Their operating cash burn in Q1 alone was $125 million. You can do that math. Total long-term debt, $532 million. Debt to equity ratio, 182 times. Liabilities are 97.5% of assets. The GAAP net loss actually widened this quarter from $50.6 million in Q1 2025 to $70.3 million in Q1 2026. A reasonable bear would say this company could go bankrupt before rates come back down, and they'd be making a fair point. Better is cutting $25 million in annualized cost starting this quarter. They sold their UK bank. They're targeting EBITDA break even by the end of Q3 2026. But this is a high-risk position. Make no mistake about that. The question is whether the upside justifies the risk. I think it does. And here's a wild card most people haven't connected to this thesis yet. 6 days ago, May 13th, Kevin Warsh was confirmed as the 17th Federal Reserve Chair. He officially took over from Powell on May 15th. Warsh has been very public about a specific thesis. Artificial intelligence is, quote, the most productivity-enhancing wave of our lifetimes. He calls it a significant deflationary force, meaning it pushes prices down. Here's what that means in policy terms. If the AI is deflationary, Warsh has a framework to cut interest rates even when inflation is above the 2% target. He's arguing AI boosts supply-side productivity fast enough to prevent inflation from reigniting. So think about who benefits from lower rates and from AI adoption at the exact same time. Better is both. They built the AI platform, and when rates come down because the new Fed chair believes they can, their conversion funnel unlocks. The new Fed chair is literally the policy argument for owning AI companies and rate-sensitive companies simultaneously. Better is both of those things in a single ticker. And that brings me to the most important question I want to address, because you know how I usually run my positions, and this one looks very different. You know my framework: covered calls, cash secured puts, the wheel strategy, 30 delta strikes, 30-day expirations, collect premium, reduce cost basis. I run this on almost every position I hold. Now that I'm better, here's why I broke my own rule. A 30-day covered call in Better right now, at roughly the $27 to $28 strike, would collect maybe $150 to $250 in premium. Nice annualized yield on paper, around 25 to 40% annualized. But here's the problem. If the Tinman thesis plays out, if rates normalize and the coiled spring releases, this stock does not stay at $25. Wall Street's average analyst price target is $46.50. That is 84% above where Better is trading right now. Needham just initiated with a buy at $53. Cantor Fitzgerald has a strong buy at $40. My personal thesis is a potential 20 times return over the next couple of years. If I sell a covered call and the stock goes to $40, I don't participate in the move above my strike. I've capped my own upside on purpose. On a position I rated 10 out of 10, I learned the hard way in 2022 that adding complexity to a position you already believe in is one of the most expensive mistakes you can make. Better is maximum conviction, pure equity hold, no covered calls. Knowing when not to run the strategy is just as important as knowing when to run it. If you're getting value out of this kind of analysis, hit subscribe. Every week I break down real positions with real numbers, actual money on the line. No theoretical trades, no paper accounts. Don't miss next week's video. Here's exactly what I'm doing with my money. 1,700 shares of Better. Cost basis $26.59 per share. Current price $25.26. I'm about 5% underwater. And I am not selling. The morning after the Q1 earnings report, when most people were panic selling, a billionaire named Thor Bjorgolfsson bought 298,756 shares of Better. That brought his total stake to 7.3% of the company. He spent more than $7.5 million in shares before most people had even finished reading the earnings release. Needham, buy $53 price target. Cantor Fitzgerald, strong buy $40 price target. Average across all four covering analysts, 46.50. That is 84% above where BETR is trading right now. Institutional money is not confused about this thesis. They've done the math. The thesis is straightforward. The Iran war is temporary. The macro clears, the coiled spring releases, and hiding inside this so-called struggling mortgage company is a B2B AI platform that went from zero to processing half their loan volume in 18 months, with a wait list of bank partners and no competitor that can replicate what Tinman has already learned from 18 months of real loan data. Could I be wrong? Yes. If rates stay elevated for 2 more years, BETR's runway gets extremely tight. The bear case is real, and I named it directly. This is not a safe stock. That is the risk I'm taking. At $25 a share with an 84% analyst upside and a CEO who called this a coiled spring. I think that risk is worth it. Here's the thing about rate-sensitive, high-conviction stocks. They move fast when the catalyst hits. The investors who do well aren't the ones who buy after the spring releases. They're the ones who understood the thesis before it did. If you want to understand the framework for sizing into a position like this, I broke down exactly that process in this video right here. Click it now. That's the framework that makes everything in this thesis make sense.